Thanks very much, Donald. Good morning, ladies and gentlemen. Delighted to be here this morning, I think. As a Waterford man, meeting a tip hurler is never a good thing, but anyway, I get on with that. This morning, I want to talk about four topics, really. The global economic backdrop, what's happening in the world. Secondly, what's happening on the interest rate front. And unfortunately, I sent these slides in yesterday, so one of them is out of date already, but I'll talk around that. The Irish economic update, just to take you through some of the key indicators on the Irish economy, and finally talk a little bit about the outlook. A lot of stuff to skip through pretty quickly, but at the end, in about 2 hours when I finish, there will be an opportunity for a Q&A in any event, if you have any questions or if you fundamentally disagree with anything I'm saying. Just to go through the international backdrop, I guess the approach I've taken is to try and highlight what I would regard as the key issues for the global economy. And the one thing I think we would have learned over the last 2 or 3 years is that we haven't a clue about economic forecasting. And anybody who believes economic forecast is mad, because when you think back to March 2020 and the declaration of a global pandemic, then we had 2 years of chaos, and then on February 20, this time last year, if I was speaking to you, I would have been saying that over 2022, those inflationary pressures that became very evident in the second half of 21 would gradually ease as demand normalised and as global supply chains came back on stream after COVID. But then, of course, on February 24th, we had Putin invading Ukraine, and that has given us 11 months of further chaos. So it just shows that the best economic forecast can be blown out of the water by events, and that certainly has been the case over the last 2 or 3 years. But anyway, I will try to set some sort of economic context. As I say, on the 24th of February last year, we had Putin invading Ukraine. Check the time to make sure I'm not going to speak for 2 hours. Putin invaded Ukraine. There was three impacts economically of that invasion. One was on energy prices and energy supply. Second was on the food supply chain and food price inflation. And thirdly, it was in the area of industrial metals, building materials, stuff like lithium, cadmium, nickel that's used for the manufacture of electric batteries and so on. And it's funny, until the 24th of February last year, I just didn't realize how important Ukraine is in terms of food, energy, and industrial metals and so on. So what we saw happening during 2022 was inflation start to take off, particularly on the energy side, but food price inflation everywhere currently running in 10 to 15% year on year, which marks a huge change from the last 30 years. So had a huge impact. Inflation took off, and central bankers who this time last year were saying that this inflation problem is temporary, it's transitory, that we will not have to do much in terms of tightening interest rates to bring it back under control. But of course, all of that changed after the Ukraine invasion, and inflation took off. And by October, inflation in most jurisdictions was running at the highest level in 38, 40 years. And central bankers responded quite aggressively to that situation. So by the end of the year, there was a lot of pessimism about the global economy. All of the official and private forecasts were talking about definite recession in Europe, probably the United States, most definitely the United Kingdom in 2023. Over the last month or so, there's a greater air of optimism, and this is relative, but there is definitely a greater air of optimism. And in fact, earlier this week, Tuesday, the International Monetary Fund published its latest forecast for the global economy. Last year, it published 3 forecasts, and on each occasion, it downgraded its global growth forecast. So that was the trend. But on Tuesday, they actually upgraded slightly, and driven by 2 things. One, natural gas prices particularly have collapsed over the last 4 or 5 months. They're still higher than they were pre-COVID, but relative to where they were in the early months of the Ukraine invasion, they've collapsed. So that's a good thing. Secondly, China has reopened. Last year, China was subject to significant COVID-related restrictions, virtually locked down, as only the Chinese can do. GDP growth of 3%, which was the lowest level of growth in China in 50 years. So China, at the end of last year, the decision was taken for political reasons mainly and social reasons to reopen. All of the restrictions virtually were lifted, and suddenly the second largest economy in the world is going to be a player again in 2023. So, as I say, that collapse in gas prices, that reopening of the Chinese economy has certainly given a greater level of optimism for the global economy about 2023. I wouldn't get carried away about it. You know, there are many challenges. Interest rates are still rising. Central bankers are determined to get inflation under control, regardless of the economic cost of doing that. Cost of living, crisis is still very evident in many countries. So, but still, there is a greater level of optimism about the world economy. But as I say, I wouldn't get carried away. It's going to be a challenging year. The second issue is what's happening on the interest rate and the inflation front. As I say, central bankers initially believing inflation was transitory. They eventually turned around and started to increase interest rates dramatically. And the Federal Reserve has taken rates from zero last March. Last night, they delivered the latest 0.25% increase, now trading at the range for their federal funds rate is 4.5% to 4.75%. And Jay Powell, the chairman of the Federal Reserve, made it clear in the press conference last night that there will be another couple of interest rate increases to come because they don't believe they've done enough yet to get inflation under control. I guess that's of academic interest really to an Irish audience in some ways, because what the European Central Bank is doing is obviously of more relevance and significance here. The European Central Bank started tightening in late July and took their key rate from 0 to 2.5% by the 15th of December. The ECB meets today, is probably going to deliver another 0.5%. So we'll be at a base rate of 3% tonight, I suspect. And how much further can rates go? I suspect that the ECB will deliver at least another 0.5% over the next 2 or 3 months. So I guess my call coming into the year was that by mid-year, the ECB's base rate will be at 3.5%. Could rates go higher than that? They could. Central banks do make mistakes, but I do believe it would be a mistake to go higher than that. And if they do go higher than 3.5%, I think rates in 24 will come down more quickly, because the economic damage of too much tightening would not be good news. But anyway, for the moment, we are in a rising interest rate environment in the euro area. The Bank of England is likely to deliver 0.5% again today. There's a bit more to go there as well. And in fact, the UK economy is the one you'd be most worried about at the moment, because since the 23rd of June 2016, UK economic and political management has been a total basket case, putting it mildly. And the economy is in all sorts of trouble at the moment. And that really was highlighted last October with Kwasi Kwarteng's budget, which led to his sacking, and then shortly afterwards the resignation of Liz Truss. Rishi Sunak has brought a bit of stability, but stability I would call it, rather than setting the world alight. So the UK, I think 23 is going to be a very difficult economic environment, and it's of all the economic areas, and it's obviously one that's of importance to Ireland. The UK is definitely the one you'd worry most about. On the political side, I could go on forever about this. I'm not going to, but if you look at the global geopolitical scene over the last 5 or 6 years, with Trump, with the Brexit referendum, Erdogan in Turkey, Orban in Hungary, Xi Jinping in China becoming more and more authoritarian, and Putin, of course. The world of politics is really becoming very, very dangerous. And unfortunately, these political events have huge economic consequences. So I spend a lot more time at this stage analysing global geopolitics rather than economics. And it is something that could keep you awake at night if you become too preoccupied with it. But it's definitely a key factor out there at the moment. Lots of reasons for it, but it's a reality. The Ukraine war and its consequences, the problem at this stage is it's not at all obvious how Putin can actually off-ramp in this war. So it's just going to continue. It's just going to go on and on for the foreseeable future. The hope would be, of course, that from an economic perspective, and perhaps this is being a bit selfish about it, the hope would be that it won't disrupt food and energy supplies any more than it has done in the last 12 months. But you know, it's one to watch, and even Jay Powell last night in his press conference was talking about the possibility of a further escalation of that war as a serious threat to the global economy. But it's something we're just going to have to live with for the foreseeable future. I get really upbeat when I go on to Ireland, okay? China, I mentioned, and I guess there's two aspects of China. One is the fact that it is reopening, so it will make a stronger contribution to global economic activity. And just remember, it is the world's second largest economy, and it is now the world's second most populated economy, because last year the Chinese population, for the first time since 1961, declined, fell by 850,000. India has now overtaken China as the world's most populous economy. But that's one issue. The second issue is that you know, with Xi Jinping becoming more and more authoritarian, you just wonder about doing business and investment in China for the Western world. I think it's an area that will have to be treated with extreme caution. But that's a longer term issue. The short term issue is that China is now reopening. It will make a more significant contribution to global economic activity this year. But financial markets, we saw equities, bonds, and indeed property very volatile, generally weak last year. It was a tough year on investment markets. 2023 has started off certainly with equity markets on a much more upbeat note. Meta is up about 17% in the last month. It came out with pretty positive quarterly guidance last night. So the equity markets are certainly looking quite relaxed and positive at the moment. I think probably too relaxed and too positive, because there's a lot of challenges out there. But for the moment, markets look good. Property is the one, in most jurisdictions, no surprise, against the background of rising interest rates. A lot of property markets are under pressure. And in fact, since last September, UK house prices have fallen by about 7%, for example. So property around the world as an asset class is under pressure. So one to watch as well. So the bottom line on the world economy is that while there is a greater level of optimism today than there has been in recent months, you know, the risks are clear, and they're mainly geopolitical rather than economic per se. And there's a lot of uncertainty out there. And every time we hear central bankers talking at the moment, they just stress the deep uncertainty that's out there. They really haven't a clue about what to do on the interest rate front, other than the trusted thing of increasing rates when inflation starts to take off. And that's exactly what they're doing at the moment. From an Irish perspective, despite all of those global headwinds in 2022, and 2022 will go down as a challenging year for the world economy, there's no doubt about that. But despite all of that, the Irish economy proved remarkably resilient. Earlier this week, we got the first estimate of growth for the final quarter of last year, and that then gives us the full year picture. But the CSO is estimating that the Irish economy last year in GDP terms expanded by 12.2%. Dramatic stuff. But I think if I had another hour to give you a lesson on Irish GDP, it would probably be worthwhile. But GDP grossly exaggerates the real health of the Irish economy. Back in July 2016, I was at the CSO briefing where they were reporting on first quarter growth 2016. And as an aside, they said, oh, by the way, we've revised growth for 2015 up from 6.8% to 26.8%. And that was the day that Paul Krugman tweeted leprechaun economics. But the CSO was reporting correctly. But what happened in 2015, we had a lot of intellectual property assets being transferred into Ireland by a few multinationals. So statistically, that did represent an economic transaction on the Irish balance sheet. But of course, in a real sense, it means very little for the real economy. So the Central Statistics Office developed another measure over the next couple of years. It's a measure that has absolutely no international resonance. It's purely a domestic construct here. It tries to strip out this nebulous stuff around intellectual property assets, the impact of aircraft leasing on the national balance sheet, and so on. It describes it as removing the effects of globalization. And they come up with a measure called Gross National Income Star, GNI Star. And it is likely last year, and we just had the GDP numbers. It'll take a while to calculate the GNI Star, but it is likely that last year the Irish economy delivered real growth of around 4 to 5%. By far the strongest economic performance in the euro area as well. So it's a good economic story, but I wouldn't get carried away about the GDP piece. It does grossly exaggerate. But the underlying picture is a good one. Tax revenues last year, incredibly strong, 83 billion, by far the highest level on record. I'll go into a little bit of detail on that in a second because I think it is significant. Employment at the end of September, 2.55 million people employed, which is by far the highest level of employment we've ever experienced in this country. Wouldn't one just love to be working in the recruitment industry in that sort of labour market background? The unemployment rate ended the year 4.3%, and in fact, yesterday the CSO published the January number, which is 4.4%. So a 4.4% unemployment rate is virtually full employment. So very, very strong, very tight labour market that obviously created huge opportunities in the recruitment industry, but from a business perspective, recruitment, retention, wage pressures, a huge, huge issue. The export side of the economy, absolutely booming. In the first 11 months of last year, up almost 27%. The thing to remember about, and this is merchandise exports, we don't have the service export number yet, but on the merchandise export side, up almost 27%. 65% of Irish merchandise exports come from the chemical and pharmaceutical sector, and that sector has boomed over the last 3 years, particularly due to or during the COVID period. But even aside from that, the agri-food sector, which is the most important indigenous export sector, and as a farmer from Waterford, I can relate to this, but exports up 22.2% last year. So, you know, the Irish export model is performing very, very strongly. So that's all the positive stuff. Really, really, it was a good year for the Irish economy. The one thing we did see happening, no surprises here, was that as the year progressed, consumer confidence dived. And in fact, by December, consumer confidence was running at the levels last seen in March 20, which was the month that the global pandemic was declared. And prior to that, the second half of 2008, when the global financial crisis was really starting to take hold here. So consumers, justifiably and understandably, very cautious in Ireland during 2022 because the cost of living crisis, rising interest rates, the negative news flow relating to Ukraine and all of that stuff. It wasn't a great year for people to be listening to news, for example. So it impacts on consumer confidence. But the interesting thing really is that that collapse in confidence did not translate into the sort of collapse in consumer spending that happened during the previous episodes. And in fact, retail sales, that's spending on physical goods, last year in value terms up by 7.5%. So we were spending more money, but that's because things were more expensive. Whereas in real terms, the volume was down by just 0.6%. So I would describe that as a remarkable performance by the Irish consumer in what was a challenging backdrop. Okay, so, and the other, I think, key point about the Irish economy is During the period of COVID, I'll talk about it now actually, if you worked in the multinational sector, professional services, financial services, the public sector, COVID had very little impact from an earnings and employment perspective. Those sectors continued to operate, wages continued to grow, people continued to earn, but there was an inability to spend because of restrictions. So we saw during that 2-year period about 16 billion more than we would normally save being saved. And that has continued into 2022 because reflecting that greater level of consumer caution, we're starting to see precautionary saving, creeping into the system. But the bottom line is at the end of October, 149.3 billion in household savings. This is money sitting on deposit in the banking system. And I'll put that in context in a second, but suffice to say, it is the highest level of saving we've ever seen in this country. And at some stage, I felt prior to Ukraine invasion, it was going to happen during 2022. But at some stage, a lot of that money will be released back into the system and definitely provides a strong anchor for the personal side of the economy. The other point I was going to make there, I mentioned the sectors that did well, whereas if you were operating in hospitality, non-essential retail, personal services, it was obviously a much more difficult environment during COVID because those were the sectors that were heavily exposed to the COVID restrictions. And I guess the final point about Ireland that one has to talk about is housing. To me, economically, politically, socially, housing is where it's at. And I'd never really understand why housing does not get a lot more significance as a key element of national competitiveness. Until this week, IBEC on Monday published a report talking about housing, the availability, the costs on the owner-occupier side, and particularly on the rental side, as now a major impediment to the future growth and development of the economy. And I'd be interested in the Q&A getting Recruiter's view on the housing issue, how much of an impediment it is now for employment generation. It's something we really, really do need to address, and I'll give you some context on that in a second. So this is what has happened on the inflation side. You can see pretty dramatic increase since the second half of 2021. Peaked at 9.2% in October, fell to 8.2% in December. And the CSO gave a preliminary estimate a couple of days ago. They're talking about a 7.7% headline rate for January. So the headline rate is coming down, and it's largely because of the decline in energy prices. This is the sort of slide one should never use in a presentation, particularly early in the morning like this. A lot of figures there, but a couple of points. The 8.2% headline rate, but during the month of December, we saw home heating oil, diesel, petrol fall significantly. So the decline in the headline rate is primarily related to energy. Whereas if you look at food price inflation, up 12% in the year to December. And that for 20 years up to the end of 21, average food prices here were declining. So this does represent a significant turnaround. But it also is, I think, highlighting that to date, energy has been the focus of the cost of living crisis. I think food is going to become a more topical issue. And as I say, a lot of that is down to the impact that the war in Ukraine has had on the global food supply chain, particularly in areas like wheat. The employment story, record levels of employment, bit of a dip during COVID, but you could certainly say Ireland is very much a lean, green, mean job-creating machine at this stage. Very, very strong labour market. This is the unemployment situation. It's an incredible performance. And this is another one of those slides I should never use. It's the breakdown of employment sector by sector. I have included this table in the publication. So There's no point going through, but it just shows you sector by sector, how many people are employed and what's been happening in terms of employment growth. There's two areas where we've seen a decline in employment. One is on the agriculture side, and the other is on the financial services side, a decline of 10,500. And I guess that is representing, the banks are engaged in cost cutting and various packages. And of course, Ulster, KBC exiting the market, all of that is impacting there. This is the consumer confidence piece. You can see the decline. That was the 2008 period. That was March 2020. That was December 22. There was a bit of a pickup in January to the highest level in 7 months. And it's kind of reflecting what I've been saying there about the greater level of optimism about the global economy. And for anybody that would have been following Davos the week before last, as the week progressed, there was a bit more optimism creeping through. And falling energy prices is just a key element of that. And this is the household savings picture. You can see that since the beginning of 2020, really, household savings has taken off. So that's a positive eventually for the economy. This is the tax revenue story, and 83 billion collected last year, the highest level on record by a mile. And in fact, since 2011, we've just seen dramatic growth in tax revenues. Over the years, I've got involved in various spats with the left on shows like Vincent Brown, where typical thing will be thrown at me. You're a typical economist. All you care about is the economy. You have no interest in society. Well, I have always argued, and I think it's been proven on a daily basis, that without a functioning economy, you cannot generate the resources to create a functioning society. And the economic growth performance of recent years has generated the tax revenues that facilitated a budget package of 11.2 billion on September 27th last. And we funded that package out of a budget surplus driven by tax revenues and economic activity. Whereas in the UK, for a decade, there's been a lack of economic growth. And Kwasi Kwarteng in October, with his mini budget, implemented in relative terms a similar budget package that we had here in Ireland, but the markets absolutely crashed. The UK pension fund industry was on the brink of collapse at that stage until the Bank of England intervened. And the key problem was that the fiscal package in the UK was funded out of borrowing, whereas we funded ours out of a budget surplus. So economic growth does generate the resources to run a society. Of course, it's the decision of the political system to decide how you actually allocate those resources. But you need a functioning economy, and Ireland, I think, is an extreme example of that at this juncture. Looking at the breakdown of that tax revenue, I think it tells us a couple of things that we need to keep an eye on. There's two elements that stand out. 30.7 billion in income tax, up 15.2% on the previous year. And in fact, in 2021, income tax revenues were very strong as well. And how were income tax revenues growing in an environment where we had 695,000 people plus in receipt of a pandemic unemployment payment? So, COVID had a huge impact on the labour market, but yet income tax revenues continue to grow. Two reasons. One is that we have an incredibly progressive income tax system here. According to the OECD, it is one of the most progressive income tax systems in the world, meaning the more you earn, the more you pay. And the second point is that during COVID, those sectors I mentioned, which were unaffected by COVID restrictions, they tend to be, they are the higher paid sections of the labour force. And it is workers in those sectors that pay the bulk of income tax here. Whereas the workers who were affected by COVID restrictions tend to be low earning sectors where very little income tax is paid. So it's the quality of the labour force that is delivering that income tax take. The second piece is the corporation tax side. 22.6 billion collected, up 48% almost in the previous year. We collected 7.3 billion more. To put that in context, 10 years ago, we would have been lucky to collect 4 billion in corporation tax. So over the last 2 or 3 years, there's been a dramatic surge in corporation tax receipts. And the question, of course, is there is a concentration risk here. 85% of that corporate tax take comes from the multinational sector. 10 multinational companies pay 55% of that corporation tax take. So clearly we have what's called concentration risk. Our corporate tax take is very dependent on a small number of companies. And of course, the flip side is that if any of those companies get into trouble, we have a problem. And when the Department of Finance published the Exchequer returns on the 5th of January, they were quick out of the traps to say that about 10 billion of this corporation tax take is transient or vulnerable, and that government shouldn't spend this money because it could disappear overnight. I don't believe it will, but that there is one challenge already presenting itself. That's what's happening on the global tech sector. If global tech profits fall, that will impact on the Irish corporation tax take. So it is one to watch. And I guess when I'm analysing the Irish Exchequer finances, I spend more time looking at the profit results of the multinationals that operate in Ireland globally. It tells us a lot more about what's going to happen. I'll wrap pretty quickly. This is the housing side. The colours have become distorted, but the middle one is the national average. The top one is outside of Dublin. The bottom one is the Dublin market. And what we've seen in the last 8 or 9 months, the rate of house price inflation is moderating significantly. No surprises there, given that interest rates are rising. This is the real issue. Rents absolutely soaring, a serious lack of rental supply in the market. To put a bit of context on this, listening to some of the political discourse around here, you'd swear Ireland was totally out of kilter with the rest of the world. Using a few slides here just to demonstrate where we are in an international context. The blue line is Ireland, the orange line is the euro area, the grey one is the OECD. It's real house prices, adjusted for consumer price inflation. And you can see there that Ireland is very much in line with the international experience. The other thing that stands out, this was the period up to 2007, 2008. It just shows, I wish I'd realised it living through it, but it just shows in hindsight just how out of kilter we were. And I think Morgan Kelly in UCD was probably the only one that cottoned onto that at the time. This is house prices as a percentage of household disposable income. You can see there we're very similar to the international norm as well. But you can also see there just how out of kilter we were in the run-up 2007, 2008. And this is a ratio, global house price to rent ratios. And you can see there we're pretty similar to the international average as well. So every country in the world virtually at the moment is struggling with the same sort of housing challenges that we are. And it's the inability in cities like San Francisco, the inability to have adequate housing supply is something that is really proving difficult for policymakers, as is the case in this country and in many other countries at the moment. So we're not alone. My final piece would be just to sort of summarise what I've been saying, and I've adopted a balance sheet approach to examining Ireland. What are the positives? Strong economic momentum clearly coming into the year, record levels of employment, low unemployment. We have a stable banking system, albeit a much smaller and more concentrated banking system, but it does not have the sort of balance sheet exposure that it had back in 2007, 2008. That is good news. But I would like to see more competition in the banking system. The public finances are very buoyant, tax revenues growing very strongly. We have record household deposits, and indeed, since 2011, personal lending has fallen significantly, outstanding lending. I don't have the graph here, but it has, and household deposits grown very strongly. So the personal balance sheet here is very strong at the moment, much, much, much stronger than it was back in 2007, 2008. But this is an aggregate number, and I think it is important to recognise that there are certain segments of society that certainly do not have these deposits. They're very concentrated in a certain part of the socioeconomic framework. But in aggregate terms, the personal balance sheet here looks pretty healthy at the moment. That's good. On the negative side, what are the threats? The external environment I've explained. Interest rates continue to rise, albeit declining. Cost of living pressures are still intense, and I've mentioned the food piece as one that we need to watch. The cost of doing business, energy costs particularly for the SME sector, it's a challenging environment. So for hospitality, for non-essential retail, for personal services, all of which are dominated by SMEs, it's a challenging enough environment at the moment. The housing market I have mentioned as, we just need to build more houses, full stop. Last year we built 29,851 houses, which is about 40% higher than the previous year. But between 2011 and 2021, we delivered an average of about 12,000 houses per year. And we now wonder why we have a housing crisis. We need to be building, depending on who you listen to at this stage, between 40 and 60,000 houses per annum we need to be delivering at this stage to bring that balance between demand and supply back into kilter. So we really do need to put housing up there as a national priority, throw everything at it to try and increase delivery. Geopolitical concerns. I've mentioned the global political situation. I would also mention in a domestic context, and I am not casting any sort of view on one's political beliefs in the room, but one thing we need to think about is the possibility that Sinn Féin will be in government late 24 into 25. Not guaranteed, and certainly will not be in government on its own, but it will represent, or it would represent, a significant change to the economic and political management of the country. And you may think it's a great thing, you may not. Obviously, 35% of the population does think it's a very good thing. But what we need to analyse very carefully over the next 12 months is what Sinn Féin's economic policy platform is going to look like. And what we know at this point is that it is a high-spend party. And if you are a high-spend party, by implication, you have to be a high-tax party to pay for that. So, and in the submission to the Commission on Taxation and Social Welfare last year, they were talking about significant increases in earnings over 100 grand, for example, wealth tax. You may think it's a great thing, you may not, I won't be voting Sinn Féin personally, but we can think about how this might impact on the labour market particularly, and the ability to attract talent. But I think Sinn Féin actually will be pragmatic enough to realise that the economic engine drives the tax revenues that fund everything else. And if you implement policies that will undermine that economic engine, you have a problem. So I think pragmatism at the end of the day will win out. So it is not the end of the world, but I think it is something we need to just watch evolve over the next 12, 18 months. And then the final point is on the global tech pressures. I'll just wrap here. There are much greater technology experts in the room than me, but it was clear that during the 2 years of COVID, and indeed into 22, the tech sector was mopping up workers everywhere, paying huge salaries. Suddenly, with the global economy in a bit of a downturn, they discover we've actually overhired, we need to resize, and we're seeing that. But I'm certainly picking up, and I'd be really interested in your views on this in the recruitment industry, that a lot of the tech workers that have been displaced are now being picked up by other sectors of the economy, like insurance, financial services, and so on, that couldn't compete with the tech companies over the last 2 or 3 years to hire. So I don't see a significant employment shock in the tech sector. But where I'd be more worried about what's happening in the tech sector is the impact or the implications for corporation tax here. That's the bit I'll be watching more than the employment piece. So that's it. This is a commercial. I do a podcast twice a week with a friend of mine, Chris Johns, where we discuss all of this sort of rubbish twice a week for half an hour. So if you're interested, listen to it and subscribe and tell all your friends about it. So, but no, seriously, on the Substack account, we also we write a lot of stuff about what's going on globally and here in Ireland. Just might be of interest to you. Well, thank you very much, folks.
Thanks, Jim. That's brilliant. I am conscious of time. I know it's 9 a.m., so people may need to leave. Has anybody any questions for Jim or the panel on anything that was just discussed? Yeah. Okay. I'll go to the lady here. She's her hand up first.
Sorry, just a question for Jim. Jim, on the housing and the accommodation issue, which is huge, and I actually know of somebody who, when they had to leave the rental accommodation they were in, subsequently had to leave the country and their job because they just couldn't get somewhere else to stay. Given that you can't actually build a house overnight, and we need to build so many, do you think the government should be doing anything to prevent the flood of landlords out of the market that aren't the new industrial REITs, etc., that are, driving up the astronomical rents that are there, which drags up an average that isn't necessarily perhaps reflective of what could be the situation if there weren't so many leaving? Because I feel like we can't build fast enough for those that are leaving, and should more be done there?
Yeah, I mean, that there is a notion out there that there is a silver bullet solution to the housing crisis. And, Sinn Féin definitely drive that narrative. And it's the reason why amongst young people, Sinn Féin is so popular at the moment, because they believe government has failed and has failed to address the housing crisis. So let's give somebody else a chance. I think there's about 20 different things that need to happen on the housing front. Small things, big things. The planning system is all wrong. The ability to object is all wrong. We need, and I like the initiative, except they're not throwing anything like enough money at it, about renovating accommodation over shops and stuff in towns, villages, cities around the country. There's a whole load of stuff. But on the rental side, I published a report last June on the rental sector, the private rental sector, excluding the investment funds and so on. And what's been clear over the last 5 years is that there's been a massive exodus of private landlords from the market, and they're selling up. And okay, people will say, well, what's the problem there? Because the house isn't disappearing. It's going to somebody else who needs a house. But the problem, of course, is that it's coming out of the rental market and it is going into the owner-occupier market. That's good. But the rental market is left with a deficit, and it's quite clear there is a huge deficit. And I was recommending at the time, and I guess since the beginning of COVID, a lot of my ideological views have changed dramatically, in the sense of when there is a crisis, government just needs to throw everything at it. It was absolutely essential that government supported households and small businesses during COVID to make sure that they were around when our economy was reopening. But likewise now in the rental market and the housing market generally, government needs to do whatever it takes, even if it means dramatic intervention and subsidisation, etc., etc. But if you ask the people who are exiting the private rent market, why are you getting out? It's because they're paying 52% tax, they're being heavily regulated through the Residential Tenancies Board, and many are operating in rent control areas. So the economics and the hassle involved in being a private landlord are forcing lots of people out, full stop. So you need to address that. Tax incentives, people do respond to incentives. We need to do stuff to get private landlords back into the market. Because if you look at a town, say Dungarvan, close to where I come from, if a private landlord gets out of that market, an institutional investor isn't going to come into Dungarvan and build rental accommodation. they're going to concentrate on the populated areas, the cities and so on. So it's massive government intervention, but they have no interest. And I believed coming up to the September budget that the government actually was going to introduce significant tax incentives and reliefs for private landlords. It didn't happen. And I believe the reason it didn't happen was, and I don't know this for a fact, but I suspect the Robert Troy situation erupted just before the budget, and government was terrified of doing anything that could be deemed to be helping landlords and politicians.
So I'll go to this gentleman here at the front. You have a question?
Just to roll it up, like at a high level, if you're looking at political issues, that's what you're really worried about, right? There's four things that people really worry about, right? Cost their home. So whether that's mortgages, and whether you think it should go up by 0.5% this year, government concludes really clear. As far as they're concerned, it's keep raising interest rates until everything calms down, right? So I would be less confident. Or it's the rents which are going up, as you can see. It's fuel, and what the people on the ground are hearing the headlines are, fuel prices are going up, but the gas companies have never made bigger profits. It's a terrible political thing. It's the financial services, like insurance and everything else, and again, they're seeing record profits versus the price of costs. And it's food, and we're a huge exporter, and like Ireland has that historical political issue with famine and everything else, where there was plenty of food, it was all going outside the country. As food prices start increasing, and bills start increasing, and the profits are still clear around exports around food, this is creating an environment where we have a really big political problem. So that's at least my opinion. What advice would you give to a room full of senior people with influence, which we are, in terms of what we can do, like whatever about the government and everything else that's out of our control, what we can do to try and mitigate the risk around that and actually do something that could make a difference before it gets out of hand politically?
Jesus, there's a question.
Get you a coffee.
I mean, on the interest rate front, you said you'd be more pessimistic than me. In what sense?
I can see go higher than 3.5.
Yeah. Well, the problem with that logic is that inflation typically is driven by too much demand. And when there's too much demand, you increase interest rates, you reduce demand, inflation comes back down. But inflation in Europe is not being driven by demand. In fact, demand is pretty weak. It's being driven by supply side problems. So increasing interest rates isn't going to bring oil prices down.
I don't disagree with you.
Yeah. So I think the ECB has done enough already, but it is going to do more. But the further it goes from here, the more damage it's going to do. And eventually that will have to be, and that's why I think 3.5%, maybe 4% at the outside is where rates are going. And I would expect them to come back down in 24 modestly. Okay, but that's just my view. Been wrong often before, so I may be wrong again. But in terms of what business people need to do, I mean, at the end of the day, the political system determines most stuff that businesses can do anyway. So I just think it's important that senior business people get involved much more in the debate and not be afraid to get involved in the debate. I mean, I was delighted to see IBEC coming out this week for the first time making really strong comments about what needs to happen in the housing market. Government needs to be convinced by business that actually if you do things that may be politically unpopular, that they will reap positive dividends for the economy. And housing is the key area. I mean, one of the problems there's many problems in housing, but one of the other problems in housing is that most of the apartments that are being built are built to rent rather than built to sell. And now where I live in Terranure, there's massive opposition at the moment to Terranure College is selling some of its land to a developer for rental properties. And my neighbours are going berserk about it. I would never, ever align with NIMBYs in any sense. So I've made myself very unpopular out there. But the reason why, and I see this justification, the reason why all of these apartments have been built to rent is because the economics of and the financing of build to sell just doesn't work. Financial institutions are very reluctant because the risks are much higher. So if that is the case, government needs to intervene. It needs to provide the finance to the developers to make it viable. It needs to do stuff like giving a VAT holiday on new housing. Over 40% of the price of a new house goes back to the state in VAT and development levies. Give them a holiday on that. It's politically very unpopular. You can see the headline in the Sunday Indo, government bailing out developers again. Developers are essential to deliver housing, so we do whatever. And as I say, I think it's up to senior business people to get much more involved in this public debate and not be afraid of the negative feedback that will flow from that. Because the narrative is being totally dominated at the moment by a certain segment.
Thanks, Jim. Anybody else? Any questions? Yeah, go ahead.
Take a longer term view for a moment. How would you see central bank digital currencies affecting the economy? Would it be a good thing or would it not?
It's funny, in the podcast, we started it back in February 21 as a COVID boredom piece, keep us sane. And we have discussed crypto a number of times. And perhaps the two of us are of a similar age. Chris is older than me, but we're middle-aged elflas, really. And we're dinosaurs, but we do not get crypto. And I've read so much about crypto, I do not get it. How a cryptocurrency could have an inherent value as an asset, I have no idea. Yeah, I'm getting there, sorry, I'm getting there, okay? To answer your question, I have to go through the crypto piece, because that's dominating the digital currency debate at this stage. To me, crypto is a total farce, okay? And we're seeing that imploding at the moment. But central bankers are going to have to step in and create their own digital currencies, and they will. So I think central bankers over the next few years will be implementing their own digital currencies. And then when they do that, and this is, the libertarians are really opposed to this notion that when cryptocurrencies become the norm, that government knows an awful lot more about what we're all doing. And from the perspective of the revenue commissioners, it's much easier to collect taxation than with a cash-based society. But that's where we're going. So I think digital is the future.
You think it's a good thing?
I do, actually. Yeah, I do. Do you?
Not certain about that.
Okay. But it's inevitable anyway, regardless.
Depends on whether you're a small landlord or not, doesn't it?
Well, that's it, you see. Yeah, absolutely. Yeah.
Great. And we've one more question here at the front.
So the two defining financial trends for the last 30 years have been declining US Treasury yields and China exporting disinflation. They both come to a halt, if not an end. What do you see, or where do you see us going in a world where we no longer have the free kick from declining yields, and given geopolitical, we no longer have the guarantee of disinflation being exported by China?
Since 2007, 2008, the world has been a weird place. You know, we've had interest rates at virtually zero for most of that period. We've had central bankers fighting deflation, trying to generate inflation. We've had massive quantitative easing, you know, trillions of euro and dollar being printed by central banks. Stuff that we'd never seen before and probably never will see again. We're now starting to go back into a more normal phase. You know, bond yields have gone up significantly in the last year. Inflation has come back as a thing. I am just not convinced that global disinflationary trend actually has gone away. I think China will re-emerge as an exporter again, okay, but nothing like the same extent. But I think Indonesia, for example, I think is going to become a major global exporting nation. And I think this global disinflationary trend actually has not gone away. I think this is an aberration. The energy piece is the one I guess you'd be most worried about. And the one thing we should really become convinced about is the need to, number one, reduce our dependence on fossil fuels as a country, but globally I think as well, and plus reduce our dependence on imports from politically unstable and dangerous countries. And here's where NIMBYism comes back into the picture again. The opposition to the development of renewable energy beats me. The parish where I come from, middle of nowhere in rural Waterford, there's civil war down there at the moment because a couple of farmers have come together to try and build a big solar farm. The whole community is up in arms about it. And I made myself deeply unpopular by digging in there at a conference recently. But, you know, we've got to accept stuff that we mightn't deem desirable, but in the long term, we've got to develop the renewable energy piece.
Great, thank you. Anybody else? No, okay, we'll move to the panel. So